The moves that we're seeing in the currency forwards markets are nothing short of alarming. Is enough being done in terms of policy to offset the impact that the coronavirus and the oil crisis are having?
Good morning. I mean, on the one side, the dislocation is on the May contract, and on the other side, Brent stayed at 25. WTI futures are at 20. So yesterday was more of a dislocation, a lack of demand, inventories are full, and the inability of consumers to actually monetize this drop in oil. Despite all that, the ability of Qatar, Abu Dhabi, and KSA to successfully place on, but obviously oil remained the main driver, especially that you have higher spending coming from the economic stimulus. I think that the strong IG fundamentals in the region have enough reserves. They will have the ability to weather the storm. The risk is more imminent on the weaker links, which are Oman and Bahrain.
How long can Oman and Bahrain be locked out of the market, Zeina? What have they got to reinforce them, and what is the length of time that they can survive without getting to market or a backstop?
I mean, absolutely, you're right. They do not have access to the capital markets, and they will not have access until the situation stabilizes and this dislocation between IG and high yield remains high. From Bahrain's perspective, they managed to take a 1.25 billion loan to repay their March maturity, and they still have the Saudi backstop in case of need. The Oman situation is a bit more complicated, even though we think that Oman might eventually turn for GCC for support in case it needs to, but the backstop is not as obvious. The spending cuts they've done are not enough to level off the deficit, given where oil prices are. But if you look at Oman versus Bahrain on a standalone basis, Oman has slightly better flexibility in the sense that they have 9 billion liquid reserves, and they can turn to their general reserves, which were roughly about 20% of GDP at the beginning of the year. But I mean, if you look at the valuation. Oman
let me just jump in here, Zeina. I mean, if I can just jump in here just to really underscore the point you're making, because the metrics are nothing short of distress levels. GTV Go for our clients. So this is the spread on Oman's bonds due in 2029. That's hovering around 1,000 bips to the benchmark. At what point does this become a buying opportunity, Zeina?
If you look at the current RV now, Oman trades 100 basis points wider than Pakistan, knowing that Oman is rated 3 notches higher. We understand that there's a risk. We understand that oil at these levels is not sustainable neither for Oman nor oil is still a valuable commodity. So we think that Oman is starting to have value. We still have volatility in the short run, but I think we start seeing value in the Oman curve.
Can I ask you, we look at what happened with Mexico. Mexico was downgraded in terms of both the sovereign and in the corporate. And I want to get your sense of where and how we look at Aramco risk in all of this. I was looking at the bonds, and obviously the price collapsed in the latter part of May as we went into the spiral of out-of-control oil price destruction. We've had this moderate recovery in the 10-year paper and the 20-year paper. Will there be more pressure come to bear on Aramco paper, Zeina, or is there a floor ultimately created by the sovereign?
A downgrade would be function of a sovereign downgrade. In terms of a floor, I mean, if Brent drops below 20, we will obviously have pressure, but we cannot withstand the fact that both Aramco and Saudi remain very strong in terms of fundamental, in terms of reserves, and in terms of net leverage. So I don't think that fundamentally we're still strong in terms of valuation. Yes, we might see another leg down if oil continues dropping.
Nomura put out a note overnight putting Egypt and Ukraine as most at risk in what they have as the Damocles currency list. Do you see it in the same way? And what can the government do or the central bank do to try and protect itself a little bit more, try to breathe a bit more?
Absolutely. Egypt is at risk because the 1 month lockdown is estimated at 4% of GDP. This is because Egypt is hit from different angles. You have from a tourism perspective, the balance of payment perspective, given that exports are dropping, and from the remittances perspective, because you have a drop in remittances. We've seen an outflow from Egypt, which was around 14 billion, but that is not reflected in the reserves. And the other thing that we look at is the currency stability, which doesn't make sense given market conditions, because this tells us that they are intervening in the currency market to stabilize the currency. This doesn't really make sense because, as a matter of fact, these reserves can be put to better use. Plus, given how strong the currency is, this makes the trade less attractive. So we think that there is more downside risk to Egypt. There is potentially turning back to the IMF for another line. So at this point, we think that there's more upside than downside than upside to the story.